the topic of this session is a panel on how to prosper in an inflationary environment. I think we all need to know that. I'm joined by Nick Hodge, Chen Lin, Nathan, and Amanda from Independence Money. So I guess we're going to kick this off. I'm just going to ask a few questions, or maybe do you guys just want to speak a little bit? You have any thoughts and ideas on the topic you want to share, or you want to ask questions?
Let's ask some questions.
All right. So we're going to do this QA style. So how to prosper in an inflationary environment. Obviously, we're at a precious metals conference. That's going to be part of what we talk about. But feel free to ask any questions, any other investments that you have, and if you want to ask anything else, that's fine too. Anybody have any questions for us? Okay, so we're gonna have to make up our content. Oh, here we go. Thank you. There's my bold. I got a bold in every audience.
You want to, Chen?
You go for it.
You know, I was talking to my talk yesterday. I put up some technical levels at a close well below 1850 or the 1840. Exactly right. So, I mean, if you look at a chart, and I'm no technician or chartist, but if you look at the chart, you know, once it broke that support level in the mid-18s, it looks like it could go to 15 relatively quickly. I mean, there's no really support in between where it closed today, the level you mentioned, and that $15 level. So, for me, that would be sort of a bottom, a trough in the price if it does continue to break down.
Yes, absolutely. In my talk, also mentioned $15. I think $15 is would be very good price to buy. Okay, I'm very bullish on silver. I think we're probably just a month away from really silver turnaround. I actually believe silver can decouple with gold. Silver can go up despite even gold goes down. So because of industrial demand, time will tell.
I agree with everybody. I think silver can fall as much as the market says it can fall from a derivative basis, from a paper trading basis. I don't think that necessarily is going to be reflected in the physical trade. I expect physical trade to stay strong. But if you look at the chart, I mean, $15 is not a bad downside target. I mean, I could go as little as 11 because we were there not too long ago. So from a paper trading perspective, if the mood in the room is, well, we don't see the bull case for silver anytime soon, that short-term 2 to 3 to 4 month paper trade that you get on the COMEX, it can go as bearish, you know, as the traders want it to. But like I said, I don't think that negatively affects the physical trade at all, in my opinion. Thank you for the question.
Maybe the same thing on gold as well,
Okay.
too.
I mean, you saw sort of gold test its lows not too long ago in the high 1600s, sort of the 1680 level. I didn't happen to see where it closed today, and I try not to look at the day-to-day as much, right? But, you know, 1680 was strong support there. It bounced like a slingshot right back to the mid-1700s when it hit there, and so I think strong support in the 1680s for gold.
Yes, I see strong support in gold as well. And also, you realize recently there's a lot of gold inflow to China. I think, you know, potentially could be Chinese government secretly hoarding gold. And there's issues. We heard one of the issues was Turkey was rumored to be selling gold because they're getting financial trouble, right? Same thing for Pakistan having trouble. South Korea recently also having trouble. So you look at the similarity, really very close to 1997 to 98. So it's but every crisis is different. So we could be, you know, a few months to a couple years away from the true bottom. So time will tell.
Okay. Yeah, I think all the answers are good. Downside price in gold, I could see maybe mid-1600s. I had Florian Gourmet, a lot of you may be familiar with him, out of Europe on my channel about a year ago, and this is maybe a little more than a year. It's when gold had popped to 1900. We were on kind of the way up to 2000. I forget the exact date. He said, you know, Rob, we could have a pullback to the 1600s. And we had such bullish momentum. I was like, wow, that's a pretty bearish call. But he was right. And he's an excellent analyst and excellent technical charter. Fully recommend his service. You guys are interested. He's not here today. But yeah, I could see that. I could see gold falling down to 1600. Again, it's derivative trading. I don't care because I buy the physical. It makes no difference to me. It's just a buying opportunity. But yeah, from a technical perspective, you read the charts. If we continue to have this, what I think is like a margin call and a liquidity sell-off, and if it continues, without us having some other financial event that would be bullish for gold, I could see it drifting down a little bit more. That's my thought. Yes, sir.
Yeah, Robert, this is for you. Again, you had that chart where the money supply has increased like 40%, I think, in the year 2020.
Yeah.
And since production really didn't change, so the credits, I guess, went up. There was no production. This difference with inflation. But isn't this with what we're doing with Jerome Powell, the raising of interest rates, like the stock market went down 1,000 points Friday, got another 500? Isn't this killing money, which means we're kind of reducing the balance sheet, coming back a little bit?
There were two measures that we looked at. The one that had in today's presentation was the M1. Money supply grew 40%, I believe, in 2020 during the pandemic. The M0, which is a little bit more restrictive and is missing like some commercial bank deposits and things, if I remember those measures correctly, had grown, multiplied by a factor of 5. So the super liquid money in society, what people immediately see as money as cash or electronic cash, went up even more than that. So we've got a bunch of money potentially sloshing around. At the same time, we've got de-dollarization and euro dollars slowly making their way back to the U.S., in which there are more dollars held in overseas euro dollar accounts than there are held in the United States. So I think that there's going to be maybe an incredible amount of money sloshing around. And then the second part of your question, I'm sorry.
Well, yeah. So isn't that the idea that he's reducing the balance sheet,
He's tightening.
raising interest rates?
Yeah.
Is that the intention, or is that a side effect?
Okay, good question. So the tightening of the balance sheet is more on the stuff he was buying, right? So in tightening, and they're actually trying to run it off a little bit, and they have run off some, is they're selling treasuries into the market, right? That's not necessarily a cash transaction, but it would more affect, I would think, bonds and treasuries. I don't think it's necessarily destroying a lot of currency, at least not, I mean, most of the currencies have been printed. It's either made its way to the banking system or to individuals, and it's sitting on a lot of balance sheets. So I don't know if that necessarily would be deflationary from like a price perspective, the tightening. I think the tightening more has to do with availability of credit for corporations and for people to take loans and expand. And so I think that'd be more of a negative drawdown on GDP. Hopefully I understood your question correctly. Okay. Does anybody else want to take a stab at that one? No. Okay. Oh, by the way, we have tax experts up here. If you guys have tax questions. Yeah. Yes, sir.
It's about surviving in an inflationary environment.
Right.
I view the metals, silver and gold, primarily as my long play. Industrial commodities for midterm play, and immediate play in the energy sector. What I'm trying to do is navigate what I see going on under my nose right now, with the hopes that I can shift out of the energy if it starts or plateau out.
Right.
Kind of in the shell game.
Well, it's whack-a-mole inflation. I gave a talk called exactly that at a conference last fall. And yeah, you have to sort of see what's going up. So we were in a severe inflationary environment for most of 2021. You remember you were being told it was transitory the entire time, while oil went from $40 to $120 a barrel in March, right? And that was the inflationary trade to be in, right? And then the inflation sort of came out, right? The mole got whacked down, and then where's it going now? Well, you sort of have to look, right? I mean, what's holding up? You know, uranium prices are up for the year. I mean, not significantly, but they closed today, I think, $51 or $53 a pound of uranium. That's higher than it started the year. And then if you look at like, I like sectors of the S&P, right? Well, I guess let me start with cash, first of all, because if you got out of some of the things that were inflated, like the NASDAQ was severely overly inflated, right? On like a multiple basis. And so if you were able to sell the NASDAQ in 2021 and move to cash, then that was a phenomenal inflationary hedge, right? Because you sold the thing that had inflated, and now the NASDAQ's down 30% from its November 2021 highs. Meanwhile, the DXY is up at around 108 or 110. 10, right? So that was a phenomenal way to hedge inflation. And then, like I say, I look at the S&P sectors, right? So energy starting to come down for a while, was the only green sector in the S&P for the year. And now things like staples and utilities are starting to perform well. So you can buy sector ETFs. I love like the SPDR ETFs, and I rotate based on what I'm seeing, outperforming. So XLU, for example, is a great one. Or drill down inside the ETFs and see what's performing well, NextEra Energy, NRG, for example. And then on the staple side of things, those companies pay significant dividends. So, we've been in tobacco stocks, for example. Those are paying 6 or 7% dividends, and you get the equity appreciation. So, people don't stop smoking when the inflation's high. People don't stop drinking. Constellations of the world, the liquor companies. That's just how I look at things. Like you said, rotate around. I mean, buy and hold might be dead, right? But in an IRA or a converted IRA or something, and maybe they can speak more about that, you can harvest profits without having to worry about sort of tax implications, and just buy what's working, like you say.
Yeah, I think to add off of that, we like the dividend stock model. That's usually what we do. We buy deep value dividend stocks. So I think in Rob's presentation, you kind of went over the stock market and tracking the PE ratios of those companies. So usually the S&P is at a PE of 35, I think is what your presentation said. So, if the stock market crashes in half, that's usually taking PE ratios down to around 18, anywhere in that range. And so we try to invest in companies that have PE ratios that are already at that point. So, and usually we like to invest in things that are inflating as well. So things that are in energy, gas, food prices, so any grocery store chains. And we also like to think about consumer defensive as well, having that in your portfolio. So that's anything, people are not going to turn their cell phone bill off, that's for sure. So, just thinking about what consumers use on the day-to-day basis, what's going up. We say if you can't beat them, join them. So just kind of thinking about that inside just your stock portfolio.
Yeah, and from a tax standpoint, you got to pay attention to the vehicle. So let's say, an ETF, a mutual fund, own the same kind of dividend-paying stocks. The taxes are different on that because on a mutual fund, explicitly, it's up to the money manager to determine what that gain is. So it could roll in as a dividend, and the money manager declare it as a short-term capital gain, or they could declare it as interest. It's up to their discretion. Whereas if you own the stocks outright, like we have a portfolio manager that does that, he's got a basket of 30 stocks. 85% of them are domestic. So that falls under qualified dividends, which is the same tax code as long-term capital gains, which means if you're in the 15% aggregate bracket, that drops to 0. If you're in a high bracket, it tops out at 20. And so a dividend model of domestic companies, you're not dealing with overseas exchange rates, and you're not dealing with shipping stuff across the ocean. It makes a lot of sense inflationary there. But let's play devil's advocate and say those stocks go down. Turn on that dividend reinvestment. Instead of them paying dividends in cash, they're giving you more shares. And the dividend is declared. It's not a percentage of the price. So if you have a $100 stock paying a $5 dividend, and that stock goes to, $50, it's still a $5 dividend. You're getting 10% more shares. It creates a boomerang effect for when those markets do rebound. Do you have anything to add to that?
Oh, well, for me, I like to invest in different sectors, right? I have mining, my family also have energy, also have invest in biotech. So each sectors have their own internal mechanism. Some sector go up, like this year, energy was doing great. So I'm fortunate for me, when my largest energy got taken out, so I have a lot of capital. I'm trying to deploy into gold and silver, especially silver, I like it. But right now, it's going down like this. I'm looking at it from tax point of view. This year, the tax loss buying shouldn't seem, tax loss selling will be severe. For me, it will be tax loss buying, right? Buy people who are selling during the tax loss season. That's usually in the United States, it's from Thanksgiving to Christmas. So keep in mind, you could have a lot of bargaining around coming to you.
Well, I'm a little bit more longer term. I like the way that you described how you're doing that, short, medium, long term. I've kind of, at this point in my life, in my age, gone to more of a long-term cycle investing, 10 to 15-year periods, rotating in and out of sectors. I don't know if that's for everyone here. Certainly the younger crowd, it may not be. But that's another way you can do it. You don't necessarily have to trade in this environment. You can just take a position and sit there. And if you're in an asset which you think is a long-term bull market, a lot of times you can make a lot of money that way. Tax implications, I'm not sure how it would affect that approach. I assume if you're holding it, you wouldn't have any near-term capital gains until you sold it. So that's my strategy, and I just made it easy on myself. Honestly, my investing is super easy at this point, so I don't sit there and worry too much about it. Yes, sir, right here in the blue. Or, sorry.
Inflation will end. And when I was a kid, you could buy gas for 25 cents a gallon, not $5 a gallon. You could buy 5 hamburgers for $1, a candy bar for 3 cents, okay? Where we are now is everything is just going up and up and up, and I don't see any end to this inflation.
So the last long-term inflationary episode, I think, was 70s, 80s, that time frame. There was a study done on it, and it went in 3 acts. It went up, and if we compare that to this period, we're in that period where we're in the first stage where we're going up. Next stage is it plateaus a little bit, and third stage it goes up again, and then you have usually an immediate policy response by the Fed, all the kind of stuff that Volcker did back then. But that all occurred, it was over something like a 100-month period. I mean, it lasted for a long time. And so if we're in a true inflationary period that has to do with amount of fiat, economy, all that kind of stuff playing into it, it may not be something that subsides anytime soon at all. It could be years before the ultimate inflation game plays out. And I think there are a lot of factors in that, so I don't know right now if I would call a specific time frame. That actually would be, a good subject for a study. But yeah, inflation's not something that just goes away very quickly. Certainly not something that goes away in months. It's more measured in years. If we believe we're in the same inflationary environment as we were back then, I think we're probably a bit worse fundamentally, and probably from a money printing perspective, a bit worse as well. A lot of that's going to have to do with how the world economy goes and how the Fed treats it.
Yeah, it might have to do with how severe the recession is and how long it takes to play out. So I've heard the Cantillon effect mentioned a few times at this conference, and that speaks to where the money starts when it's first distributed. We've printed trillions of dollars in response to COVID over the past couple of years. We've passed infrastructure bills, we've passed Inflation Reduction Acts that spend hundreds of billions of more dollars, and that has to work its way through the system, right? It starts with those closest to government, companies, corporations, high net worth individuals, and it flows all the way out, and that takes a long time. Think of like honey dripping off a spoon into a dish, and how long it takes to drip all the way to the edge. It's still working its way through, and so you have to sort of look at the economic cycle a little bit, I would say. And housing tends to get hit first, and we're sort of seeing that now with interest rates making it so that people can't afford the amount of house they could afford last year, and we're seeing deals not get closed as fast or at all, and we're seeing less waiving of inspections and buying sight unseen. And then from housing, it moves on to sort of industrial and large ticket orders. And then from there, it trickles down into profits. You haven't really got into an earnings recession on the S&P yet. The earnings growth is now only starting to contract. That takes a time to work its way through. And then from there, it cascades into employment. And while we're starting to see freezing and hiring and layoffs, we haven't really seen a massive blow to employment. That takes time to work out. Previous cycles, we need to 12 to 24 months, and sticky high inflation could be with us for a while, to continue the belabored honey metaphor. 12 to 24 months, it could, and it might not be 8 or 9% like we've seen recently, but 6% relative to a 0% federal funds rate that we saw from 2008 to 2015 feels like super high inflation, though in a historical context it might not necessarily be. So I think 12 to 24 months is a good maybe time frame to keep in your head.
So I agree with both of you. I don't think it's going away anytime soon. I think we also usually compare it to the 1970s a lot. I've been hearing that all over the internet. And I think there's some key differences to highlight, especially comparing it to the 70s. We're not only having inflation in the United States, we're having it on a global scale this time. And I think that's a large thing to take in a fact to what's happening on the global scale. Europe's printing a ton of money. We've seen the euro drop below the dollar now, which is definitely going to cause some major issues. And we're also seeing a lot of energy issues that we didn't see in the 70s as well. And that's on a global scale too. So I think that's something to definitely think about. It's not just here, it's all over.
Yeah, I agree with that. This isn't the 70s. I don't think in this case history repeats itself. First off, we look at Volcker like he's amazing, but they hated him back then. Our politicians are spineless. Nobody has that kind of gall to do that anymore. The Federal Reserve used to not talk to the politicians. Now they're influenced by the politicians. We didn't have the debt to GDP that we had back then. If you raise interest rates up too high, it's going to take 100% of our budget just to pay the interest on the debt. And quite frankly, why do they care to lower inflation? Because if they're issuing treasuries at 3% on a good day and inflation's at 19, you understand negative arbitrage. That's in their favor all day long. I also say, like, let's apply it to the swimmers in the pool. If you put 5 swimmers that really aren't good swimmers and one Olympic swimmer, and you say you can't touch the sides, who's going to go down last, right? The other currencies are in bad shape compared to the dollar. Is the dollar in great shape? Maybe not. But compared to the others, like, the United States knows these other currencies are going to go down way faster than ours. So we don't have a losing position in that scenario, and that's kind of my thoughts.
Yeah, and I just want to add, even we saw the gold, silver went down very hard recently. Dollar also goes up. In the term of euro, it's doing much better, right? In term of Turkey, lira, Turkey, what happened in Pakistan, in South Korea, in their local currency, they're still doing good. I mean, gold is still valued as a valuable asset throughout the world. So don't get too depressed, that gold dropped, okay? So, and also, a lot of gold mining companies operate outside United States. So for them, the local cost will go down. So actually, that's a tailwind for some gold mining company. And I do think gold and silver mining company, I do think they are getting cheap.
So 2-part question, probably start with the tax people. What are some of your high net worth clients doing right now, specifically since the start of 2022, and then fold over into the rest of you guys from an investment standpoint? What's the big money doing?
Are they business owners or just? Well, I mean, any investment you have, even with the cheapest cost investment in the way of expense, is precious metals. Like, if you store them at home, there's no cost. If you store them in a vault, it's nominal cost. But all investments have some sort of cost. The biggest cost is taxes. I think high net worth people know that they got a target on their back. I think they know taxes are going up. We were just talking earlier about Puerto Rico. So if you're a business owner, there's structures you can do to create a legitimate tax deductible expense against that LLC, and that money shows up in a reserve account in Puerto Rico where it's not taxed at all for the majority of people, or for the minority, it's taxed at 4%. So they're getting money in tax havens. And then to your point, don't look at the fishbowl as just the U.S. There's still stuff cheap internationally, and especially when you mentioned the gold overseas. I think you were saying like Argentina or some of the other countries, it's a whole different valuation than it is in the United States. So I think learning that there's other markets as well helps.
I think we're seeing a lot more people diversifying as well. I think a lot of our high net worth clients, whether it was a business owner or just someone that had high net worth, were heavily concentrated in the stock market, and they loved those growth stocks. And I know back in 2018, people were asking us, well, why aren't you guys in growth stocks? Like, what are you doing? Why am I not making money like that? And now they're coming back to us and saying, wow, that was actually a good idea. But I think diversifying out of that and diversifying into other asset classes, or we have a lot of people that were highly concentrated in real estate, and now they're looking at other markets like precious metals or real estate outside of the US, or cryptocurrencies as well. So
Yeah, if you had a lot of money in tax-deferred 1031 swaps all in the United States, I would be very scared about that, and I'd be taking proactive action.
I mean, I've been selling. Chen was talking about tax loss season being in Thanksgiving. Tax loss season for me has been most of the year, right? I've been trying to reduce my future obligations, getting rid of my losers and holding cash, which has been really strong. And then, if I just look at my own household, it's tightening the belt, right? It's continuing to hold that cash and not spending as much as we were, which of course begets more pain in the economy, which is why I think we're going to continue to see, negative earnings and contracted growth and flat or negative GDP. And so, and then from a business owner perspective, it's, figuring out ways to try to generate more revenue, whatever those might be, right? And thinking about contingency plans for employments. If you look at like the small business consumer sentiment, it's the worst it's ever been. It's lower than 2008 to 10 period, right? The small business owners are really scared. And I guess I have to concur with that sentiment. I've got 10 full-time employees and we don't just pay their salary, we pay 100% of their insurance premiums as well. And I've got probably 4 1099 people. So, I'm thinking, not how am I going to let them go, but how am I going to keep them for now? I mean, at least the way I view my business is like a community, right? I don't want to have to fire my people. And so that's a real honest answer that doesn't have to do with the markets, but the pain out there is definitely real.
Yeah, I think from my perspective, it's been deleveraging. I'm debt free now. I don't have any investments in which I'm worried about that may not perform. I've been cleaning out, but that process has taken me probably years to do that. I started that process in 2010, got rid of my pension, got rid of my 401k, took the tax penalty, and took the money and invested it. And right now I'm just super liquid. But I think you asked what's going to do well. I think energy will continue to do well, especially given the sort of the bifurcation or the multi-polarization of the energy market now, and the expense cost of transporting it. So instead of Nord Stream 1 was shut down today by the Russians, and now they have the Chinese, shipping it, and you've got LNG being shipped from the U.S. to Europe as well. So energy futures probably a pretty good, bet. Anything that is contrarian to the health of the dollar and the bond, gold, silver, of course. But I would honestly, what I would do in this environment is I'd look for business opportunities. Not necessarily passive investing or buying a thing, but maybe investing in a person or product that you think is going to do well, in the future. Certainly I've done some of that as well. So I've started investing in people and even tools and processes, and that's been pretty lucrative. And I will say this, there is a lot of money seeking return right now. The private equity market is absolutely exploding. And so if you're interested in raising money for a business or for real estate, private equity could be a really good way to go. Of course, there are a lot of regulations around that, so I'd consult a professional. But there's tons of money seeking investment right now. You back here.
Rob, I know you were familiar with Robbie Farber. I don't know if everybody else is. He did a video which I found very interesting. I had to look at it 3 times to make sure I could wrap my head around it. And I'm going to ask you guys to maybe put your 2 cents in. I'm not sure right away we're going to have inflation. He was talking about the destruction of the M1 coming down, and I think it was due to the bankruptcies that the Fed has been causing. Now that there's having to pay actual interest rates on.
I know the chart he's talking about.
Yeah. And I'm trying to wrap my head around that.
So essentially, what I think if you're talking about monetary aggregates, what he was talking about was you've had M2 start to decline. Is it M1 or M2 start to decline? I think M1 start to decline a little bit. And then I kind of followed upon his theory and said, well, if you inflation adjust it, because there's an inflation adjusted one printed by the Fed, it's diving down faster. So I interpret that as meaning the money that had been printed is now all less effective. It's deflationary, right? And so maybe the amount of money printed is not going to have quite the effect that we thought it would. And if that accelerates, I mean, that could be deflationary for maybe for businesses. We'll have to see what will happen. But that was a really interesting chart he had. And basically, he's just trying to show the money supply is coming down. Usually when the money supply or the credit comes down, that means recession, essentially in the longer term following that period. You guys may not be familiar with the chart, but he was talking about decline. Okay, we're good on that one. Did that answer your question? Yes, sir. Somebody had their hand up over here, I believe. Right here.
Earlier today when you talked, you kind of hinted that you are heavy cash. I don't want to put words in your mouth. And then you just spoke about being heavy cash right now. Or so obviously when you have cash at some point in time, you're going to deploy it. What kind of things or signs will you look for to start putting that or getting more aggressive putting that cash back to work?
Yeah, I think GDP growth instead of contraction is certainly one. Major indices starting to make higher highs instead of higher lows or lower highs, which they've been making. A breakout in the major indices would be the things that I would look for. And then the dollar starting to weaken, right? I mean, I don't see a real sign of that yet, but those would be three major things, I would say. Breakouts in the major indices, GDP starting to turn back around. There's a great tool. I see the chart all the time now. Everybody's hip to the Atlanta Fed Nowcast. They update it every couple of weeks with Atlanta Fed Nowcast, I believe is what they call it. GDP Now, it's called. And they update that every couple of weeks, and you can keep a close monitor on that. And so that would be it for me.
I may be the one guy up here that doesn't keep a lot of cash. So, I'm a tax guy and I'm worried about inflation. So, we actually design for clients LIRPs, life insured retirement plans. And the idea is to work against the life insurance company, get the absolute minimum death benefit. The IRS requires you to buy and then put the maximum amount of cash you can without mecking the code. The advantage there is what they're doing with that money is they're taking out an option against a risk market. So if the market goes down like the S&P, you get a zero. That to me is the same as cash in the bank, right? But if the market goes up, you get a percentage of the upside, and then those gains lock. So if it goes up one year and down the next, you got a positive followed by a zero, followed by a positive, followed by a zero. To me, that's a lot better than cash. But it's like 90% liquid. So, you sign a form 3 days later, there's fiat in your bank account. You can buy whatever you want, no questions asked. So when gold's dropped, I've actually taken that arbitrage out and bought, metals with it. And when they rally, I could sell the metals and put them back. But the money in that account is tax free. And it's outside of the banking system. If you look at FDIC, it's Federal Deposit Insurance Corporation. The insurance companies are backing up the banks. I'd rather have the money in the insurance corporations because they're not loaning the money out, so they have less counterparty risk of loan defaults. But like you mentioned, it's tax-free.
Yeah, for me, I'm pretty heavily invested still, but I also have some dry powder. One idea, just caught my mind. I was just thinking, we were talking about silver can drop. Silver dropped to 15. It would be a good time to buy. Maybe you should buy some physical. Because it's very hard to imagine silver will stay in the tin for a long time because a lot of the silver mine, even the primary producer, will close down, right? So, and then silver is needed everywhere. So if you can hold it for a while, if you can be a long-term investment, you can start to back up the truck. You use our knowledge.
Thank you. So we know that platinum is 30 times more rare than gold. We know that platinum is a monetary metal. I've been studying the markets for about 50 years, and I cannot understand why platinum sells for half the price of gold. Now, I know the catalytic converter story and everything else, but if fiat money is depreciating at 8% a year, why haven't family offices or very high net worth people discovered platinum? Why is it hated? Why is it overlooked?
Yeah, I can try to answer a little bit then. Actually, I study platinum a little bit. So I invest in those PGM mines, okay? The PGM mine, the biggest profit center is rhodium. Then it's palladium. For them, platinum is a byproduct. So they just keep producing. They're trying to meet the demand for rhodium and palladium, and then they're producing platinum. Platinum has a surplus, kind of similar to silver situation. So the industrial usage after Volkswagen scandal, for the diesel is going down, right? So, and then they produce as a byproduct. They don't care. They just produce it. And for producer, if you're a South Africa producer, majority or 90% profit is from palladium and rhodium, and platinum, any price they're willing to sell. You have a willing seller and then not enough buyers. But I think platinum right now is very interesting at 800 plus because we already saw very strong evidence. Anytime it drops below 1,000, there's a big buyer from China. They just keep scooping up the platinum, keep buying. It happened. You can see the trade data, the platinum where it goes. I think it's pretty cheap. I think it's very cheap. I mean, I can't say it's the bottom, but I think it's very, very cheap. Go physical, actually, if you can.
Yeah, I think platinum kind of fell out of favor a little bit as people figured out palladium was better at most things. It's a little bit harder for use in jewelry. It's a little bit lighter weight there as well. And it's a little bit more effective when using catalytic conversions for most engines. So as Chen mentioned, a lot of the platinum moved over diesel side. Platinum used to be the dominant one, but palladium, soon was discovered to be a little bit better in a lot of qualities. But there is substitutability. It's just that, as palladium price has been high, you could have additional demand for platinum, but it's retooling processes. It's not exactly the same to build those with the two metals. So I do, however, think that there is a lot of upside in platinum. And one thing that you said is extremely interesting to me about a Chinese buyer coming in and taking platinum, because I'm sure, given the demand that they expect to see in their economy, they could stockpile that platinum and use it, and they don't mind, substituting that for palladium. And I could see platinum going up very high, and it's something I talked about in my book that I wrote back in 2009. I talked about China stockpiling commodities, so it does not surprise me at all if they're seeing arbitrage opportunities between similar complementary metals or substitute metals that they'd be buying at a cheaper price. And so I don't know, is your view on that, Chen, that over the long term, do you think that Chinese buying is supporting the platinum price, or do you think it's just opportunistic when the platinum price falls?
Well, the Chinese is a very optimistic buyer. Okay, they bought a lot of copper in 2020. They bought, they start to have like a state reserve, something like that. Platinum is something China don't produce. So they will need it. One thing you have to think about from the Chinese government point of view, they have a risk, they run a risk, potentially war with the United States. So what will be needed if there's a war? And then a lot of things will be cut off, right? So they probably need a lot of platinum. I think they also like gold, they like silver, they like many commodities, at least you put in the reserve. From their point of view, have real platinum, the platinum bar in the vault is better to holding US dollar. Think about that.
Yeah, and Chinese were stockpiling other things that I wrote about back in 2009. They were stockpiling iron. They had ships off the coast just stockpiling all goods that would last, steel, any product they could have. And so it doesn't surprise me if there are opportunistic buyers on any of the commodity markets, for sure. Any other questions? Over here.
So my question would be more of the real estate. You guys talked about great opportunities in Latin America, and I was just wondering, in the next few years, as we see interest rates kind of fluctuating here in America, where do you guys see a better opportunity, here in the States or in Latin America? And then a second part to that question would be, outside of Latin America, where do you see another opportunity where you can invest into real estate?
So I guess to answer the first part of the question on Latin America, yes, it's definitely in Central America a budding market. They're not really affected by interest rates because Latin America does not have mortgages. So that's something that's unique there. There's actually a specialized bank domiciled in Belize that has almost like a special clearance to offer mortgages to people down there, but they have to be investors and you have to put at least 50% down. And I think it was about 6 months ago, the interest rates were higher than they were in the US, but now we've seen that shifted. So it's a niche market, but I definitely think it's an expanding market. They're very self-reliant. They have their own food system, and we can attest to, we ate all the food down there, and boy, does it taste a lot better than the food here because it's all fresh and it's all local, and they don't rely on a lot of other countries for their source of income. you go see these people, they're working very, very hard, and they know that if they don't work, they don't eat. And I think it's a very different sentiment there. I think there's also a lot of investor dollars starting to move down there because of people wanting to get investment by citizenship or other things like that, or also the Zoomer generation. Everyone works at home, so why not go live in a beautiful destination that's a lot cheaper than the United States? Do you want to kind of speak on real estate?
Yeah, I mean, domestically, I'm waiting to see things shake out. So, I look at macro trends. I think you guys mentioned I play the long game. So I'm not the guy to answer what's going to happen in the next 3 or 6 months. So like you mentioned, there's the Zoomers. So there's a lot of people that can go move into a tropical, beautiful environment and go surf or scuba dive in the afternoon and eat great quality food. There's a heavy increase in amount of Americans and Canadians and Australians that are wanting to move out of the country. I think, Americans are at an all-time high, go figure from what's going on right here. And I want to see how that shakes out. And you can get great quality health care there. So for retirees that are getting squeezed in America for inflation, their money stretches a lot further. Now, we've talked about the baby boomers problem here, and we've talked about how people don't want to work in America. They don't have that problem there. They don't have that big baby boomer bubble, and they don't have lazy people. They actually work. And so that's something I'm attracted to as well. But when we interview a lot of expats down there, the number one phrase they say is, I got my life back. I'm giving jobs to locals that are the gardeners and the cleaners and the cooks and the errand, runners. And I just work, 6-7 hours on Zoom, and then I get to play with my kids. That lifestyle, I think, is going to be very attractive to independent, libertarian-minded investors as well. Did that answer your question?
Yeah, just the second part to it. Outside of Central America, where do you kind of see that boom coming next?
I'm okay. You want to get the...
Yeah, so the developer we work with, I know, so they have those islands off the coast of Portugal that they're starting to develop. So I think there's some emerging markets over there. But other than that, they are also starting to develop South America. I know there's some developments they're looking at in Chile and Argentina, and I think Paraguay as well. But I think that's more of a long-term thing. That's more of a 10 to 20-year business plan for them. I think right now within this short-term market, within the next 2 to 3 years, a lot more Americans are going to move to Central America, and it's closer to the United States, so it's easier to get back and forth to see family.
And you have water down there, so we have a lot of drought up here. There's a great book I recommend called Disunited Nations. It feeds into every topic we've talked about, from metals and everything else. As the United States pulls back from being the global police, we're going to have to see how distant parts of the world play out on country against country. And with Europe, that kind of bothers me. The United States Navy will always protect our hemisphere. So anything North, Central, or South America, I think is going to be in the world we're used to, where America keeps it safe and keeps people out. But, who knows? I mean, you saw what we're doing in Europe and in the Middle East. We're saying, hey, look, we're done being the world's police. And I want to see how that shakes out before I look too much further.
Good answer.
We're done. Thanks, guys.
Oh, go ahead.